This course is called Markets and Allocations. Previously, we understood how consumers behave. Now we want to think about what happens when we introduce markets. So, question, what happens when we introduce markets? We're going to need to worry about firm-to-firm interplay. We didn't have that before, but now with markets, we're going to have firms mixing it up with each other. And we're going to need to understand the interplay between consumers and firms. The driving force here is something that we've talked a lot about, and we will continue, and that's profit maximization. We want to think about how firms maximize profits. We have three types of firms. Sole proprietors, we call them sole proprietorship. We have partnerships, and we have corporations. Well, let's talk about these with respect to profits. In the case of sole proprietorship, it's pretty straightforward. If I open my own company called Larry's Tree Trimming Company, I get a chainsaw, I trim some trees, I make a little money, that money goes right to me. The harder I work, the more income I make. The less I work, the less income I make. But I'm the controlling factor, and I'm doing it, making the optimal decision because I'm keeping that money. How about partnerships? Well, it's the same thing. If I partner with my buddy Bob, and we have Larry and Bob's tree trimming, we go out and work hard, and then we split the profits down the middle. So we know the harder we work, the more money we get. In corporations, the owners, that is the shareholders, are not the managers. You got ranchers in Missoula, Montana. You got shrimpers in Galveston. You got farmers in Central Illinois. You got lots of people who are owners of this company. Take example IBM. IBM has millions. Now, the people who are running the company know a lot about running a large tech company like IBM. The owners, the rancher in Missoula or the shrimper in Galveston, probably knows very little about running a large high-tech company in a global marketplace. So the question here is, do these managers actually act in the best interest of the owners? It was not a hard call when we did the sole proprietorship. The person out there swinging that chainsaw around, Larry and his tree trimming service, gets to keep it. So he's going to work the right amount to make the right amount of money for him and his family. Not so in this case, this corporation. The money is going to go to the shareholders, and not so much to the companies. And so the key word there is so much. Let's talk a bit about how this works. And I want to start by thinking about what's the value of an asset in perpetuity. So here, we're recording this lecture on the campus of the University of Illinois Urbana-Champaign, and our community is surrounded by corn. I can get in a car and drive 10 miles west, get out of my car, and I'm going to be standing right in the middle of a vast farm. Now suppose I go out there. I park my car and I walk up to the farmer and I say, hey, I want to buy some land. I've always wanted to have a piece of land. I'd love to have a piece of corn land. I don't want much. I just want 1 acre. How much money did you make on this acre? And the farmer said, well, you know, funny you should ask. I just finished my harvest last month. My accountant's gone through everything with a fine-tooth comb, and it turns out I made about $200 an acre on this land. And I say to him, well, have I got a deal for you? How about if I give you $210 for it? After all, he only made 200. Now, what's that farmer going to do? Well, he's going to laugh at me and tell me to get off his land. Because it's true that if I paid him $210 for something that he just made $200 off of, it would have been a pretty good deal for this year. But that land is an asset in perpetuity. That's corn land that's going to generate a crop again next year, and the year after that, and the year after that, and the year after that. And so what that farmer is going to have to do is he or she is going to have to, in their mind, make a calculation. What is the stream of future earnings I'm going to get off this land? And I'm not going to part with it unless this joker gives me enough to compensate me for what I would have gotten if I'd have held on to it. This is a problem that requires us to do something called discounting. We need to think about how to create something called a present discounted value. So the farmer would say, hey, I can get $200 this year for profit, and suppose I think I'm going to get $200 next year. Well, if I think I'm going to get $200 next year, What's that worth in today's money? Because after all, this joker's here flashing a big stack of green $100 bills. Well, let's see, $200 a year from now, my bank is paying not very much interest, maybe 1% interest. That means if I put $99 in the bank today, it would be worth, or if I put $198 in the bank today, it would probably be worth about $200 a year from now. Or the reverse is, $200 a year from now is comparable to have $198 right now. See? Think about that. If my land is really going to produce $200 next year, I'd take $198 from this joker, put it in the bank, it'll be worth $200 next year. So if he gave me $198 for that year, that would compensate me. Well, I'm going to have it 2 years from now. Well, 2 years from now, I've got to make the calculation thinking of 2 years worth of interest. 3 years, 4 years, each time it's going to be worth a little less because money in the future is not worth the same as it is today. But I'm going to make that calculation. And if he doesn't give me enough to compensate me for that, enough money to put in the bank to replicate what would have been my stream going forward, I'm just going to say no. So this is a common problem, assets in perpetuity. Things like taxi cab medallions. If you think about New York City, if you want to drive a taxi cab in New York City, you need a medallion. And they were actually called medallions now. They used to be little medallions that you hang in a cab, but now basically they're just licenses to drive that cab. Okay? All cabs have to have them. And the license in 1947, these medallions were worth about $2,500. That was a price to pay once, and you had it in perpetuity. 2 years ago, taxi cabs were $1.2 million. Think about that. One taxi cab, that taxi cab medallion is worth $1.2 million. Now, you know it's been a long time since you jumped into a cab and had a feeling that the driver was a millionaire. The driver doesn't own the cab. Somebody with a lot of money owns that medallion. And that person, she hires out cabbies on a daily basis. The cabbie will come, in fact, the way the market works, so the cabbie will pay the owner a certain amount for a shift. The owner takes that money, say $250 for a 6-hour shift, and then the cab goes out, and the cab can work as hard as he or she wants. Can sit around all day and eat donuts, and they're just out their money, or they can take that cab and beat the streets, and they'll make a lot of money that day. From the point of view of the medallion owner, they've got their money. If it's a good day or a bad day for cabs, they've got their money. They do that every day. Every morning they'll lease out a cab for the day for an hour or whatever. 1.2 million. Today, it's down to 630,000. Now, why is that? Well, it's one little four-letter word, Uber. Uber has moved in to Manhattan, and as a result, all taxis are earning a lot less money. On any given day, taxis are not making as much as they did before. And what that meant was that the cabbies would not pay the owner of the medallion that much money to rent the cab because they're just not getting that much anymore. Uber is taking away a lot of their business. So since the amount of money the cabbies are willing to pay the license owner on a daily basis is falling, it's just like in the farmer's case, if the per year profit was smaller, then the stream of funds out into the future would be lower, and the amount that the farmer would be willing to part with that asset would be a smaller amount. In this case, in just 2 years, these things have lost half their value, okay, which is a pretty shocking number and shows the impact of this. But this is the same thing we have to do when we think about the price of a share of stock. Think about the price of a share of stock. Where do you think prices come from? You see, that's what I'm taking this course for, Larry. Markets. There is a giant market. Let's call it how about a name like New York Stock Exchange? And the New York Stock Exchange is just a big collection of demand and supply curves. People all over the place. On any given day, today, if whatever day you're watching this is the day that the trade is open, over 1 billion, that's with a B, let me say it again, over 1 billion shares will trade hands every day. Okay. Now, what's happening here is that people who have the stock are suddenly thinking that stock's worth not as much. The price of that share of stock captures the long-run rights to being an owner. It's an asset in perpetuity. If I've got that sheet of paper that says I'm a stockholder, I get the profits, that my share of those profits for this year. Now, remember, there may be 1 million shareholders out there. So if the profits are $1 million and there's 1 million shareholders, you get one. All right, but you get the picture. That's just for one for this year. And then you know there's going to be some profits in the second year, we'll call that year one, but you've got to discount that. Remember that story? The money a year from now is not worth the same as it is today. There's a certain amount less than that you could put in the bank today, and at the discount rate of 1 plus R, that is the 1 plus the interest rate, here R is the interest rate, at that interest rate, that gives us the discounted value of next year's returns. But there's another year. But this time I have to discount it twice, right? So it's 1 plus R squared, because there's 2 years worth of setting in the bank. And then there's 3 years out. And I'm going to get some earnings for being on that, and it's going to be discounted 3 times, and you get the picture. This goes all the way out. 1 billion shares trade hands every day. Why is that? Well, the value of a share of stock in your head is the present discounted value of that discounted stream of earnings. And on any given day, you could ride in on the train to work and be reading a paper and read a story about this company and say, man, that story's got their act there. That company's got their act together. I think that company's going places. And you could look at what the price is and you say, I'm going to call my broker and say, give me some of those. Tell your broker what? You want 400 shares of that. And the broker goes out and gets it. Now, that was a transaction, voluntarily, where someone sold you their 400 shares and you bought them. As soon as you bought them, you turn around and say, yes, I knew it. I wanted to be in there because I can see that this is undervalued. In my mind, the stream of numerators is going to be much stronger. The person who sold it is saying, yes, I got rid of that dog. I knew I should have settled on it too long. I don't really have any confidence that the management is going to have that stream of numerators go as strong as I would like it to. Expectations, expectations, expectations. Every day, something happens to change those. A few months ago, we had the shocking news from the Environmental Protection Agency that Volkswagen had, at least Volkswagen had allegedly, and Volkswagen has subsequently admitted this, put some software into their cars that was basically reporting improper results on emissions tests. And what happened the next day was carnage. Basically, in 2 days, that stock price lost $30 billion in value. The price went down so fast that the stream of numerators in everybody's eyes across the world who were trading Volkswagen thought, oh my goodness, this company's in for a world of hurt. And yesterday they were walking around happy to be Volkswagen shareholders, happy to have Volkswagen shares in their pocket, thinking about buying more of them because it's the second largest car company in the world. And all of a sudden something happens and everybody's expectations, that stream of numerators, that, oh my goodness, this company it's completely overvalued. What we thought was going to be the value of holding on to that and making year in and year out dividends and profits, not happening, not going to happen anymore. Okay, and so this is a pretty good approximation to think about this. Today, in American corporations, because if you remember, what we're doing this for is we're talking about, do we think that our profit maximization is a good way to think about corporations? And the fact of the matter is that today, American corporations, boards of directors determine compensation for the people who are the high-level managers. The C-suite people are determined, their salaries, their compensation determined by the most important committee on most boards of directors is the compensation committee. And they will make these types of decisions. And it wouldn't surprise you to know that they are very cognizant to tie into the compensation of these leaders large amounts of stock in the company. Sometimes they're just stock options. Most of the times they're a combination of stock options plus real stock. But you see what they're doing? By tying those shares of stock, making that a major part of those managers' compensation, those managers are just like the rancher in Missoula and the shrimper in Galveston. They want that company to do great, because to the extent that it does great, that's going to change their compensation. So we're pretty comfortable with using this profit maximizing as the motive for what drives companies, be it the small-time Larry's tree trimming, the slightly bigger Larry and Bob's tree trimming, or a major corporation employing more than 500,000 people. It works.